Alright, we're going to look at the stock issuance worksheet today. So this is going to be the lecture video that goes along with that worksheet that you can find on Blackboard. The first question that we look at on this is going to be ABC Corporation issues 10,000 shares of $1 par value stock for $15,000. What we do when we issue shares is we have to look at what are we getting. So in this particular case, we are getting cash, and it is going to be for $15,000. We then have to look at what our par value or stated value is, if they have a par or stated value. In this case, we have a $1 par value. We're going to issue 10,000 shares with a $1 par value. And so that is going to equal $10,000. And then we need to look at what the excess amount is going to be. And so the excess amount over par is going to be $5,000. So when I look at this particular journal entry, I want to look at where we're getting cash in. That means our cash balance is going up, which will mean it is on the top. It is our debit. So the journal entry we will look at here will be for cash, $15,000. We will have common stock that I abbreviate as C/S for that par value, that $10,000. And then we're going to have our paid in capital in excess of par for common stock, which we are going to abbreviate as PIC, par, and that will be for $5,000. As you can tell, our debit accounts equal our credit amounts. So we have $15,000 as debits, $15,000 as our credits. And that is how we would work the journal entry for a stock that has a par value. Now that next one is also a stock with a par value, but it doesn't tell us the full dollar amount that we are going to be receiving. We actually have to look at that. So what we do is we look at what we are getting, and what we're getting is going to be 10,000 shares, $18 per share, so we're actually going to be getting cash in of $180,000. We then look at the par value, and we have 10,000 shares with a par value of 1, and that gives us $10,000. And then we would have the excess here of $170,000. So when I look at this journal entry, first question, is cash involved? The answer here is yes. What's happening to it? Well, it's going to be going up, which means it will be on the top. It is going to be our debit account. So we will have cash as our debit for $180,000. Common stock is issued at the par value, which is $10,000. And then we're going to have our paid in capital in excess of par for common stock at $170,000. Again, our debits equal our credits. This is when we don't have the total amount. We have to figure it out based on a per share price. This next one, it says ABC Corporation issues 20,000 shares of $1 par value stock for $20,000. So what are we getting? Well, we're getting $20,000 in cash. We are going to be issuing, we have 20,000 shares, $1 par. So that gives us $20,000 as that amount. And so our excess here will be 0. So when we have an excess of 0, this is when we have sold it at par. All right? So sold at the par value. What we will have is we have cash of the $20,000, and our common stock is going to be $20,000. Notice we don't have a paid in capital in excess because there is no excess for this particular problem. The next problem that you're going to come to on the worksheet says XYZ Inc. issues 1,000 shares of no par value stock for $10 per share. If it is no par value stock, then I cannot have an excess. So what I look at is I have 1,000 shares that I'm going to issue out for $10, and so that is going to be a total of $10,000. So the journal entry that I will have here is I will be getting that $10,000 in cash, so that is my debit, and the credit account here is common stock for that $10,000. Again, there's no par value, so I cannot have an excess of par here. So the common stock is going to be the total amount that I'm actually receiving when I have no par value stock. The next one says MX issues 2,000 shares of no par value, but it has a stated value of $1 for $10,000 total. So on this one, I have to look at this stated value. Even though it's no par value stock, it does have a stated value. So the way I look at this is, what am I getting? Well, I'm getting $10,000 in. What in this case is the stated value? Well, I'll take the 2,000 shares, $1 stated value, that means it's $2,000, and therefore I'm going to have an excess here of $8,000. So in this journal entry, cash involved, the answer is yes, it is increasing, so it would be on top as the debit. So I will have cash in the amount of $10,000 as my debit. My credits will be common stock for that stated value amount, which is $2,000. And then I will have paid in capital in excess of the stated value for common stock is going to be a credit for $8,000. Now, I write this sometime as paid in capital in excess of stated value. I can do it as paid in capital, and I might write the word stated. Either way is fine for this particular journal entry. I let you abbreviate because I know I wouldn't want to have to write paid in capital in excess of stated value / common stock every time. So that's why I do let you use those abbreviations. The next one, MX is a new company whose stock is not traded on the stock exchange. They issue 2,000 shares of no par value stock with a stated value of $1 to pay for their organizational expenses in the amount of $3,000. Now, I want to move forward and I want to look at this because when we issue stock for something other than cash, we have to look at some rules. And so the first rule is, do we know the fair market value of the stock? If the answer to this question is yes, then we use the fair market value of the stock. If the answer is no, we then have to move forward and we have to look at the fair market value of what we're getting. So those are the things that we have to look at when we issue it for land or organizational expenses, legal fees, things like that, and payment for those things. We have to look at, do we know the fair market value of the stock? If the answer there is yes, then that's what we use. If the answer is no, we do not know the fair market value of the stock, then that's when we would use the fair market value of what we're receiving. So in this particular case, it is not traded on the stock exchange. Therefore, we do not know the fair market value of this particular stock. So, fair market value of stock in this one is unknown. So, what are we getting here? Well, we're getting those organizational expenses, or what's getting paid here. And so you have those organizational expenses, and they're worth $3,000. Now, what are we giving up? Well, we're giving up 2,000 shares of $1 stated value, so that would be $2,000, and therefore we have a excess here of $1,000. So when I look at this journal entry, cash is not involved here. What we have is we have an organizational expense is going to be the account that we will be using here, and that is for $3,000. We then look at, we have common stock is what we are issuing. We do that at that stated value, which is $2,000. And then we're going to have a paid-in capital in excess of that stated value for $1,000. So here my debits equal my credits, and I'm done with this particular journal entry. The next journal entry says ABC Corporation stock is traded on the New York Stock Exchange. Its fair market value is $28 per share. They issue 1,000 shares of $1 par stock for land that was being sold for $35,000. So what we have here is we are looking at this fair market value. The fair market value of the stock is $28 per share. So what we are actually receiving, we will take 1,000 shares times $28 per share, and that is $28,000. We then will go through and look at what the par value is, and the par value here is $1, and so that is 1,000, and so you would have a excess of $27,000. So what I'm looking at here is I am going to have land, and the land is going to be valued at that fair market value of the stock, which is going to be at $28,000. It is not valued at what the land is being sold for. It's valued at the fair market value of the stock. So that's $28,000. We have common stock at that par value of $1,000, and then we're going to have paid-in capital in excess of par for common stock is going to be $27,000, and so that is what we're going to have there. The last one that we have on the worksheet is about preferred stock, and it's done the same way that we do common stock. It's just that the account name is a little bit different. So ABC issues 1,000 shares of preferred stock for, it has a par value of 100, but it's being sold for 150. So we have $150,000. We have 1,000 at 100. That's the par value is at 100,000. So we're going to have an excess of 50,000. So when I look at this journal entry, cash is involved. It's going up, so it's going to be on top as the debit. So we will have cash for $150,000. We will have preferred stock here. Notice that's a P/S for preferred stock, 100,000, and then we're going to have a paid-in capital in excess of par for preferred stock for 50,000. Now notice the way I abbreviated here was paid-in capital, comma, P/S, because it's paid-in capital for the preferred stock. So you want to make sure you use those different accounts when we deal with preferred stock. But this is really all of the journal entries that you will see on issuing stock, whether it be common stock, preferred stock, issued for cash, or issued for some other asset or some other expense. So hopefully this helps your understanding of how to actually work these journal entries.